Shopping online is just so much more convenient and less expensive than shopping in person. And that favorability is only going to increase over time. There is no advantage that brick and mortar retailers can retain against online retailers that is sustainable longer term. Amazon and Shopify are benefiting from that trend and will continue to do so. But which one is the better stock to buy today? That's the question I'm going to answer in this video, comparing these two stocks across revenue, profit margin, cash flow from operations, valuation, return on invested capital, and the forward 5-year earnings per share expectations. So let's take a look at those critical financial metrics for Amazon and Shopify stock investors and answer which one is the better buy today. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Starting with revenue growth, you'll notice that Shopify has held the advantage over Amazon over the last decade, but that lead has narrowed in recent years. In the most recent quarter, Shopify's revenue growth of 20.72% was much faster than Amazon's growth of just 10.12%. I suspect Shopify's revenue growth will continue to beat Amazon's revenue growth, and Shopify will continue to gain market share in the e-commerce segment against Amazon. That's because Amazon is so large at this point and has so much market share that its growth expectations are not as robust as Shopify. Shopify favors to merchants that want to retain more control over their customer relationship management versus Amazon, which offers merchants access to more customers, but also takes away some of that customer relationship management advantages. Looking at the operating profit margin, Amazon has had the significant lead in this metric for the last decade, but Shopify recently closed the gap. In the most recent period, its operating profit margin of 9.51% went ahead of Amazon's 9% in the most recent quarter, in the most recent trailing 12-month period. Looking ahead, Shopify's operating profit margin will likely exceed that of Amazon because Shopify runs a more asset-light business model compared with Amazon. You can see this big drop-off in Shopify's operating profit margin. This is a big blunder when Shopify invested billions of dollars in fulfillment and logistics. Prior to that, Shopify wasn't involved in shipping and logistics as heavily as Amazon was. That shipping and logistics side of the business is what brings down Amazon's profit margins. It's a very expensive and capital-intensive area to be a part of, and Amazon already has such an advantage in this category that for anyone else to invest billions of dollars to try and build a network to compete with Amazon is unsustainable and unreasonable. Shopify realized that and sold off its logistics and fulfillment business, and that's why its operating profit margins have exploded back up again. Going forward, Shopify's margins will be ahead of Amazon, but Amazon's margins are improving as it has some lucrative segments, including the advertising business, which is doing very well and increasing the company's overall margins, and the cloud segment, which is more profitable than the e-commerce segment by a large magnitude. So each of these two players will likely experience rising profit margins over the next several years. Looking at earnings per share growth expectations for the next 5 years, the analysts on Wall Street that are following Amazon stock expect it will grow its earnings per share by 30% per year over the next 5 years. Now, nobody knows what's going to happen in the future. These are just estimates made by assumptions and forecasts by the analysts that are following Amazon stock, but they are well-informed forecasts from those analysts. For Shopify, the analysts that are following Shopify's earnings per share expectations expect it will do much better than Amazon over the next 5 years, forecasting its earnings per share will grow by 47% per year over the next 5 years. And that's very similar to its previous 5 years where it increased its earnings per share by 41%. Looking at cash flow from operations to sales, you can see Amazon, again, was well ahead of Shopify over the last decade, and in recent quarters, Shopify is closing the gap. Amazon is still ahead at 17.86%, but Shopify is catching up at 16.8%. Over the last decade, Amazon has done a great job expanding this metric, and Shopify has as well, especially if you exclude that blunder, the billions of dollars of investment in fulfillment and logistics. Now, return on invested capital is a very important metric I look at when I'm considering investing in a company. This measures how good a company is at using investors' money to invest in products and services that generate profits. It's the core skill a business should be good at. And in this metric, Amazon has been getting better and better. 17.06% in the most recent period. That's up from negative in 2015, negative or flat 1% here. Shopify as well had been doing a great job, except again, I'm sounding like a broken record here, when it made that big blunder and its return on invested capital collapsed. And that's a huge mistake that I do hold against Shopify's management. If you're going to make a mistake of this magnitude, that's something I'm going to hold against management, because I'm entrusting management teams with my capital. And if they're going to make these kinds of investing mistakes, I'm going to be less trusting of these management teams. And the opposite is also true. If you build a strong track record of using investor capital wisely without making mistakes, and if you make mistakes, the mistakes are relatively small, you're going to increase my trust and increase the amount I'm willing to invest in a company, because I can trust management to make wise decisions. That's been the case with Amazon's management team. Amazon's management team, in fact, is one of the few companies that I give credit to for doing an excellent job during the last 5 years and the unprecedented changes in consumer behavior. Remember, we went into a pandemic, and then there was the economic reopening, and then there was the supply chain shortages, and then we had inflation. We had several unprecedented swings in consumer behavior, and not very many businesses managed that very well because it was so difficult. I thought Amazon did a great job with this, both going into the pandemic and coming out of the pandemic. I thought management at Amazon did a great job. Shopify, not so much. And that's when they made that several billion dollar investment in the shipping and logistics, which I highlighted as a mistake. And finally, I wanted to compare these two on valuation. And I chose to use the forward price to earnings metric. And according to this metric, Shopify is trading at a forward PE of 53.75, while Amazon is trading at a forward PE of 29.37. While Shopify has been improving and catching Amazon in several metrics, Amazon is still ahead of Shopify in return on invested capital and cash flow from operations to sales, while it's very close with Shopify in the operating profit margin. Shopify leads in revenue growth and will likely continue leading in revenue growth and earnings per share growth for the next 5 to 10 years. Still, I don't think Shopify deserves this much of a premium valuation against Amazon. I would pick, if I was to pick today between these two stocks, I would pick Amazon as the better stock to buy now. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.